Hey, welcome to another edition of Coffee with Kirk. Hope your week went well. Today, it's going to be a short session today. I know I say that every time. I'm going to push it up to that hour mark all the time, but yeah, this one's going to be short. There's a couple segments I was working on. From client questions, specifically one question about gold and another kind of a deeper dive on housing. I just didn't find all the resources I needed. Needed more research time on that. So the big part of what I was going to talk about has kind of been pulled out. So I'm just going to kind of briefly hit a couple things. The first thing was something I didn't get to last presentation. I got questions right away, specifically after the Chevron case. So basically, if you haven't been following, the Supreme Court came back out and sort of clarified and said, look, sort of put the change on the regulatory agencies a little bit and says that it's going to have to be Congress or the courts that kind of make the decisions when there's not very clear, compelling evidence, or I guess I should say not specifically legal written word from Congress stating how things should be enforced. It essentially took all the regulatory agencies and took away a little bit of their ability to set the regulations and essentially make it law. So from a constitutional standpoint, I think it was a great decision. And I think I got asked this more, how's it going to affect the financial world? And that's going to be hard to tell. But I mean, from a constitutional standpoint, I think you got to like it. Because what was happening is Congress would pass laws and then executive would sign it into law. And then at that point, all of these three-letter agencies are basically on the executive side, so under the president. And they were basically filling in where they thought there were blanks in the law with regulations that they came up with. So really what you had was the executive branch of the government setting law. And the thing is, this was as good as law. They weren't just regulations. Because what they would do is the regulatory agents could come in. They could cite you, your firm, your company. They could mandate penalties, interest, fines, whatever they want to do. And then when you fight it, the first step up is really essentially administrative boards or courts run by the regulatory agencies. And even if it then went into the legal system, because of the Chevron case, they basically would follow the courts would follow what the experts, they said that the experts, the Chevron case said that they have the right to determine the ruling or the rules when there's no clear legal language in the law. So essentially they were legal bodies. So the Supreme Court came out and just said, no, that's not right. That's too much power in the executive branch. So at this point, it's either going to have to be specifically written into law, or the courts are going to be the ones that have the ability to determine what the intent of the law is and who's abiding by it or violating it. So I think if you believe in the constitutional government, the three branches having clear, definitive responsibilities, I think it's a great decision. But now there's a lot of people that argue, well, look, you're taking power away from the experts, people who know this field very well. So you're essentially putting in the courts that may not have the technical capabilities to actually rule on these issues. So it's hard to tell, but I think from an actual legal aspect, and I'm not a lawyer, I don't even play one on TV, but I think it was a good decision in my mind. But let's dig a little bit deeper and jump in the slides like I always love to do. And I think one reason it's a good decision, from the decision back in 96, you can kind of see the number of regulatory rules, the rules in the Federal Registry from 96 until today. I mean, that's an enormous increase in the number of rules that have been implemented across all the agencies. That's a lot. To go from basically under 20,000 to over 120,000. So the other thing that I try to point out to people, a lot of folks who are arguing that we need these experts because they have technical capabilities that, say, Congress or the courts wouldn't have. But here's how I think it really works. And I'm going to start off with just a comparison of the financial regulations in the SEC. So the first thing that you got with every regulatory agency is a revolving door. So a lot of the people that are working in the three-letter agencies, they're there for a while, but then they know they can leave, get some expertise, and then go into the private sector and essentially work for the companies that they were just regulating the day before. And they're going to make a lot more money doing that. So they sort of bide their time until they feel it's right to head out and go work for the companies that they were just previously regulating. So, just looking at human nature, if you're going to be going out for jobs in the private sector, and that, hey, if you were a real, Nazi on the regulations on the companies, just incredibly strict, and you only did what you thought that maybe the science or logic told you to do, and you completely neglected the private sector's interest, do you think you're going to be able to get any kind of job in the private sector, making substantially more, if you were just sort of a pain to them? No, you're not. So where you're really getting just pure technical competence and objectivity with a lot of the three-letter agencies, no, you're not. And that revolving door is pretty big. I know a lot of people that have worked in these agencies, and they've all gone to work and make a lot more money working for the companies that they were supposedly keeping in check. So human nature just says that there's really not that. I don't think that benefit exists as much. Now, are there people who work for the three-letter agencies that are, let's say, pure, and they're really focused on kind of the benefits of the American citizens? Absolutely. Yeah. They're probably people who've been there for 25, 30 years, and that's what they focus on. But they could be, and I don't know this, but they could be a small minority, even if they're only 50%, as high as 50%, you still are going to have some issues with that. But the bigger issue, going back to, say like the SEC, it's really, a lot of times they're set up so that they only benefit the big guys. The big guys actually like the SEC because they have the money to navigate all these rules and regulations, whereas a little guy like me, it's a real problem. It gets to be a pain. The more and more regulations that I've got, the harder and harder it is to actually do the job that my clients pay me to do. I'm spending more of my time doing ridiculous little bureaucratic activities and not doing financial plans and all that good stuff. And the other thing is, even if the regulatory agencies try to go after the big guys, it doesn't really work. For instance, I think it was 2020 or 2021. I was looking, the SEC has a line item for about $25 million of legal fees that they will basically have at their disposal if they're going to go after somebody. So if they think you've really been negligent and they're going to try to take you to court, they've got $25 million. Now, for me, that I can't. I'm in trouble on that one, right? I'm not going to be able to legislate that. There's no way I've got $25 million to fight this thing. even if I'm absolutely certain that I'm right, they could out litigate me. So I'm at the beck and call. So little guys are going to be pushed around by the regulatory agencies because we have no alternative. I mean, unless it's just so egregious that what they're doing to us, they know they wouldn't win in court. But there's just I've got no recourse there. But if you're one of the big brokerage houses, I mean, 25 million, that's a typical Thursday for them. So what you find in most of these times when the SEC does bring actions against these guys, they settle, but they don't claim any wrongdoing, because the SEC knows, like, if they actually try to take these guys to court, the big houses are going to out litigate them. That 25 million, that's a drop in the bucket. The big guys will spend 100 million to be able to, fight it and to avoid any kind of wrongdoing. So it's really sort of a feckless regulatory situation anyway. And I'm assuming that this is going to be the same for pretty much every three-letter agency. I'm just giving you sort of my perspective. So little guys, they're going to shove us around and do whatever they want. And the more regulations they put on top of us, the more likelihood that we're going to probably be deficient in some of these things, and not things that help the end client. I mean, at the end of the day, what clients want to mostly make sure of is that we're not stealing your money. That's the biggest thing. And when you look at some of the biggest thefts that have happened, the SEC should have caught them. They regulated, they went in, they looked at Madoff's books more than once. It wasn't just the SEC. It was also the NASDAQ, New York Stock Exchange. I mean, they were regulated, or they had inspections several times, and they didn't catch Madoff stealing from clients. And then you can also look at the FTX situation. Now, crypto certainly isn't, isn't regulated like the securities industry is, but still, they were getting reports of what was going on. They did look into this. It should have been something that was caught, but it wasn't. So if the major thing that clients want, protection from the government, don't steal from me, if that can't be picked up on a massive scale, when they're in there looking at books and records and everything like that, then you have to, again, question, is it really a lot of technical competence there? So, trying to play chess a little bit, what's it really, how's it going to impact? So again, a lot of people who are constitutionalists are, fired up about it. Finally going to have a situation where Congress is going to have to be more specific in the law, or the courts are going to have the ability to actually look at it and do some interpretation of the law. But this also opens up some opportunity for new ways to clog the system up. So people who really want to fight this stuff, who are big advocates for the regulations, and people who have an objective, and specifically what I've been reading a lot about is people that have kind of used the EPA to slow down a lot of development, that have really pushed for the clean energies of solar and wind, not nuclear. They fought nuclear. This will make it harder for them on first take, but when you start to look at and say, okay, there's only 865 federal judges out there, that may seem like a big number, but when you're talking about over 120,000 regulations that now may have to be relitigated in some fashion, that's going to clog up the court system. So a lot of these groups that want to basically set law through the three-letter agencies are now going to have to do it through the courts. So you're going to probably have a situation where these groups are going to look for judges who maybe are very activists, or will put freezes on developments. And then, of course, you're just going to have appeal after appeal, with the hopes being that if they don't want a project to take fruition, then if they can string it out for 3, 4, 5 years, increase the cost, then people won't even undertake the project to begin with. So, you could end up seeing a much more clogged up legal system. And you could just see a lot of projects go to the wayside because it's just going to take so long to get the project off the ground. And then, of course, you look at, this could be a boom for lobbyists, because now all the bills are going to have to be a little bit more specific. So, we've all heard about these 1,000-page bills that nobody's reading. Well, now they might become 2,000-3,000-page bills. So that's going to add more complexity to the legal system. That's going to probably force a lot more lobbying, make bills a lot more convoluted. And then if you find out that some of the language that goes in some of these laws, you try to go back and fix it, that at that point you're going to face a ton of lobbyists to fight it. So it could actually make passing laws even more difficult. Not that we have a system right now where that they're cooperating at all, but cooperation might become even more strained if that's even possible. So what impact is this going to have on financial markets? Well, I think it could possibly make things a lot better. We could see things move quicker. Less regulation would make a much better situation for companies. But if we end up getting a more clogged situation, just the opposite could happen. So I don't know. I don't know what the impact's going to be on financial markets. We're only going to find out as time progresses. But, it may not be the panacea that a lot of people thought it was going to be when this happened. But we'll see. I'm not sure myself, to be quite honest. Okay, so again, trying to keep this short today. The one thing that's sort of been interesting that's starting to happen really this week, I've been talking about for really 2 years now about the yield curve inversion. So again, what does that mean? It's a crazy sounding thing, but in a normal situation for the bond market, what you see is lower maturities, shorter maturities have lower yields than longer dated. And just think about it in simple terms. I always say this: if you're going to loan me money, if you loan me money for a week, you're probably going to ask for a lower interest rate than if you're going to loan it to me for 10 years. Because over 10 years, there's a lot more risk. Something could happen to where I'm not going to be able to pay you back. Inflation could come in and that's going to fight the interest that you're going to receive from me. So there's more risk for a longer term investor. So normally you see the yield curve goes like this. So the yield, and then as we stretch out over time, it goes up. That's normal. Right. So again, if you're loaning money to the government for 1 year or 30 years, you're going to want more money for that 30 years because there's a lot more risk. Now, when this yield curve inverts, what's happening is you have short-term maturities yielding more than longer term. So all of a sudden, instead of having a curve that goes up, it's going the other way. So your 1 year might be yielding more than, say, a 10 or 20 or 30-year bond. And that doesn't make much sense because there's more risk for the person with the 10 and 20 or 30-year bond. Usually what this tells you is the bond market sees longer-term growth having issues. So to get that bond yield for 10 years or more, the interest rate comes down. So an inverted yield curve usually is a sign that the bond market's giving us that things aren't looking too good. And we talked about this in previous sessions that it is a phenomenal predictor of an upcoming recession. Now, the question is, how long does it take for the recession to show up? And the thing is, it doesn't show up until that inversion corrects itself. But when it does, when you actually get that correction, it's since 1960, it's been a perfect predictor of the recession. Every time we've gone to reversions like this, and they look at a couple things. They look at the 2-year Treasury compared to 10-year, the 3-month Treasury looking at 10-year. When those things revert, every time since 1960, a recession has shortly followed. Now, some of these recessions were mild. Some of them were pretty painful. And this just kind of shows you, going back to 1978, the reversions we'd seen. And the thing to look at is the far chart, the number of days from inversion to recession. And you can see it's really all over the map. It takes a long time sometimes to finally see this happen. So it's not one of these tales that as soon as it happens, boom, you're going to have a recession. But usually within a year, you start to see the problem come about. Well, right now we're at a point where it's been the longest period from when the yield curve inverted to recession, and we haven't had the recession yet. Previous to that, it was right when the 2008 crisis hit. It was 705 days then. So, we're clearly way past that one right now. Now, the only inversion that's lasted longer than the one we've had right now, it goes back to 1926 to 1929, and so we'll see. I mean, maybe this will be the first time since 1960 that an inversion hasn't caused a recession. And again, it doesn't tell you how deep the recession is going to be. Although the longer, if you look at these periods here, the longer the reversion stays in existence, typically the more painful the correction. But it doesn't mean that. It doesn't mean that's going to happen. If you look at 1988, that was a long inversion for 566 days. But and then 1990 was a really mild recession. Unfortunately for George H.W. Bush, it happened right at election time, but it wasn't really all that bad. So when we look at things here, this is the yield curve looking at the 2-year and 10-year, which is the big one that everybody focuses on. So you can see we actually, for a little bit, it did go positive for just a tad, but then right back to negative, back up to positive. And it's just been floating around that kind of zero bound rate right now. So it got pretty deep in 2023, the inversion got real deep, and it's been coming up since then. And it's still, if you look at the 2 and 10s, it's still inverted a little bit right now. But if we look at the 2-year and 30-year Treasury, it has now uninverted. So we now have at least the 2 and 30-year to the point where the 30-year is now yielding more than the 2-year. Now, it's not much. I mean, it's a fraction of a percent. And it could turn right back around. But it has inverted, and we'll see. Again, inversions, when we come out of the inversions, that's when you really see what's going to happen, what's happening. And this is just a graph showing how the yield curves typically steepen, how they actually get to the point where we go from an inversion to a normal sort of up and to the right. So if you look at it's the bottom two, it's either a bull steepening or bear steepening. Now, interestingly enough, a bear steepening is actually a good thing. A bull steepening is a bad thing. So what a bear steepening, so we're looking at the bottom right. A bear steepening just means that the longer dated maturities, 10-year, 20-year, 30-year, their yields are going up faster than the shorter dated maturities, say treasury bills or 2-year. So we go from an inversion to a normal yield curve because the longer dated stuff is moving up faster than the shorter term. And the reason, even though it's called the bear steepening, it's actually a good thing for stocks and the economy, because we're getting back to a point where banks are willing to lend on longer term basis. They see that there's some growth in the economy and they feel comfortable lending for the longer term, 10, 20, 30 years. And investors do the same when they're looking at bonds. They feel confident in what's happening, so they don't go to the shorter term maturities. They'll go out to longer dated maturities and invest there. And obviously, like anything, if there's more people, if there's more demand and the supply's the same, you're going to get price go up. So a bear steepening, even though you see the word bear there, you think that would be bad, but it's actually kind of it's a good thing for the economy and stocks overall. They call it bear steepening because a lot of longer dated bonds, when the interest rates go up, they do lose value. So for the bond market, it is kind of a bear market, because if you hold a 10-year treasury and then over the next days, weeks, months, the yields are going up, well, the bond that you hold is losing value. So that's bearish for the bond market, but good for the economy. What we're kind of seeing right now is what they call a bull steepening. So bull steepening for the economy and stock market typically isn't good. What it's saying is that the rates on short-term maturities is going down faster than longer dated. So the 2-year T-bills, everything like that is dropping faster than what the 10 or 20 or 30-year bonds are doing. And again, what that's saying is the banks are no longer loaning for long-term here. They're worried about the growth. So they're going to things that are safer, more secure. Same thing for investors. They're typically going shorter term just because they're worried about what might be going on in the economy. So it could be economic growth, or it could also just be, it could be inflation fears too. And again, the reason that the short term goes down faster than longer term is if everybody is nervous and they're running to shorter term stuff, which is even safer. Again, higher demand, same supply, prices have to change. So right now we're kind of seeing a bull steepening, but again, it could all change, but we'll see. We'll see if it does. This is the thing I'm watching. And I know bonds are a little more confusing than stocks for people. And the thing, I've said it a million times on these podcasts and videos, the bond market is the one you really need to watch. It's not as sexy as the stock market, but it's the smart brother, is what I always try to say. The smart money is on the bonds. The bond tells the better story longer term, the more correct story longer term. So I would say bonds are like the brother who's, very intelligent, really focused. And then the stock market's more like the brother with ADHD. It's just hyper and running all over the place. But over time, the bond market drives the train. So what does this mean for the Federal Reserve? Well, this is a comparison of the federal funds rate and the 2-year Treasury. So the Fed's fund rate is in red and the 2 years in blue. And what you're going to see from this is basically the Fed eventually just follows whatever the 2-year Treasury is doing. And they're usually delayed a little bit. So when you go through this, there's a pretty strong correlation to this. But again, if you look at the red line, it's always sort of a little bit behind the action of the blue line. which means the Fed is sort of following what the 2-year does. And the fact that the 2-year is now dropping pretty good. If you look at the far right of the chart, the 2-year is dropping. So people are expecting the Fed to start to lower interest rates. And the 2-year dropping, it could be, reduced inflation fears. But usually when you see this kind of thing in the bond market, it's more focused on the growth. So the 2 years coming down, figuring that growth slowing, and the Fed's going to follow suit. Again, the Fed's fund rate right now is at 5.2%, and the 2-year Treasury is at 4.57%. So the markets are once again pricing in sort of some rate cuts. And it looks like in September, the Fed's probably going to cut rates at least 0.25%. Now, if things get a little hairy in the markets or unemployment or something like that, they might come down a little bit faster. But that's sort of what's going on in the bond market. But stock market, you still have a situation where very aggressive posture by individual investors. We're kind of in that euphoria stage right now, and we've been there for a few months. I've talked about stocks. I'm not going to get too much in stocks right now, but this sort of gives you, through the end of June, what things are doing. And it's all been a handful of technology stocks that have been the upside of the market. Everything else is just not doing anything. So Dow Jones is up 3.8. Small cap stocks, which is the Russell 2000, so smaller companies, they're up 1% for the year. Any market outside the U.S. is at 4%. And then the 10-year Treasury is actually down so far this year, 1.8%. So really, if you take out the NASDAQ at 18%, which when you look at the S&P, you say, oh, that looks good, but that's pretty much just all the NASDAQ components that have done so well, pulling it up. And last time I went into, the very short handful of stocks that are doing this. But again, just looking at it, it's kind of a scary market because there's so few companies leading the charge, and the valuation for the market overall is just really high. This is Robert Shiller's price to earnings ratio that he does. Robert Shiller is a Nobel-winning economist, and what he did is he looks at 10 years of earnings. So he basically averages out 10 years of earnings. So it sort of smooths out the fluctuation because earnings are a very volatile input to the investing climate. So he looks at over a 10-year period just to give you an idea of how the market valued relative to other periods. And if you look at it, we're at a point right now that the only time this has been eclipsed was 1999. The Shiller P&E was much higher at that point. But right now we're even higher than we were in 1929, start of the Great Depression. Doesn't mean we're going to have a market crash. And the thing is, and Robert Shiller will admit this, it doesn't tell you anything about what's going to happen next few days, next few months. It tells you more what kind of return you're going to get over a 10-year period. But what it usually shows is when you get up to the levels that we're at now, there's just a lot more risk. People feel confident, right? Those investors are very euphoric, but this is, from a logical standpoint, it's the riskier period to invest in it. And, looking at a couple things, some of the, I've talked about leading indicators here. Some of the biggest leading indicators, sectors in the market, looking at home building, you look at financials, and then you look at consumer discretionary. Those are some of the areas that sort of let you know things are getting a little crazy out there. This is a chart of those three. So the XHB, the orange line, is home builders divided by the S&P 500. XLF is financials divided by the S&P 500. And then RSPD is the discretionary divided by the S&P 500. And you can kind of see all three of those really started to turn down well before the 2008 debacle that took place. And we're kind of seeing the same thing today. We're seeing all three of these things start to head south. It's basically the health of the consumer. So it's saying, home building starting to slow, which is one area that consumers go to. Obviously, discretionary spending. So that's going to be stuff you don't have to purchase. It's not staples. And then financials kind of tell you a little bit of the health of the banks, but also if they're not lending as much, they're not making as much money. So that you could see consumer demand going down for lending. Again, don't know what that necessarily means. It could all reverse too, but it just sort of adds that there's a lot of risk out there. And this is looking over the past 20 years, and it's saying what's the current price to earnings, which is in the orange dot or diamond, if you want to call it that. And then the blue is sort of focused more on the 95 percentile, the one standard deviation. And then the 10th and 90th percentile is the white. So it's just saying for each sector in here, what's the current price to earnings and what it typically have we seen over the past 20 years. So obviously with technology carrying the day, you can kind of look at the far left there. IT is at a 29, which is substantially higher than the average, the median, and really even the 90th percentile. We're well up above that. And same for the next one, which is growth, which a lot of the growth is obviously IT. But you can kind of see there's really not a lot of cheap sectors out there. I mean, industrials, healthcare, while certainly not ridiculously overvalued, still beyond its 90th percentile. So it's kind of in, uncharted waters there. It's on, very high valuations. And again, evaluations don't tell you what's going to happen in the very near term. They don't, but they do give you kind of an idea of what the value you're going to get as an investor. So as you look at these, the things that sort of pop out, if you come to the left of the chart, utilities are pretty fairly valued right now. Value's got some value stocks have value to them. They're not too, overvaluated, but they're not necessarily raging cheap either. But energy has been, it's quite cheap right now. It's not as cheap as it's ever been, but it's still offering extremely compelling valuations, which is why I, kind of like that. You don't know when the market's going to reward you for that value when everybody's jumping into IT, but at some point that stuff does turn around. And considering the high valuations of IT in such a small handful of stocks that are carrying the market, when it finally turns, it could be a little bit ugly. But we'll see. Nobody knows. Nobody knows what's going to happen. And then I've just got one last chart. This is just one chart, one off. I've talked about Japan in a few of these Coffee with Kirks. And the reason I'm just talking about it is I feel like Japan's at that point where they don't have any good decisions. They've been trying since 1989 to have inflation and been fighting deflation. And now they got inflation and it's causing a massive situation because to avoid the deflation, the government has created just such a massive amount of debt, even more than we have. So they're at a point where if inflation happens, bond investors are going to want a higher yield in order to incorporate for the effects of inflation. But Japan can't afford to have higher yields, so their central bank is purchasing bonds to keep the interest rates artificially low. But when they do that, when they're printing that money, it's now at the point, because of the inflation, that the Japanese yen is coming under pressure. It's losing value rapidly relative to the US dollar. And that's bad too, because that's going to force more inflation, which means that they're going to have to print more money for their bonds, and which causes more inflation. So they're at a point where they either have to save their bond market or they have to save their currency. And right now they're trying to dance back and forth between the two. So just this week, basically the Japanese central bank sold about $22 billion of US dollars and then bought Japanese yen to bring the yen back down. It was, just approaching 162. So it's brought it back down to about 157. And this is sort of the range that they're hoping to kind of keep it there, even though that's still awfully high, but at least it's not getting to the point where it's getting nutty. But this is the third intervention just this year. I think the total that they've done is about 68 billion. So they're really getting into a tight spot. And this is going to have ramifications. It's the third largest economy out there. And the bad news for Japan is they have to import basically all their oil, their industrial metals, everything like that, a lot of their food. So they're in a tough spot, and it's going to end up manifesting itself in some way in the markets because there's been a yen carry trade. So a lot of people would go and borrow in yen because the central banks kept rates so artificially low, and then they could come over here and invest in U.S. assets like treasuries and get a little bit higher yield. So there was a spread there. But if this sort of starts to break down and that trade breaks down, you're going to have people covering their yen carry trade, which is going to make things even worse for the yen. So it could be one of these that really unravels pretty quickly. So again, just something I'm watching. No, not a lot of people talking about it. Yeah, everybody's always focused on the U.S., but this could have some ramifications. So I'll finish off with a disclaimer like we always do. And we'll cut the slides. So yeah, we'll be done a few minutes early, not 45 minutes. Okay. Let's see. Good comment. Cybersecurity has to be a great area of investment for any companies you like. Yeah, we're finding that out this week. If you haven't followed CrowdStrike, which is basically an enormous cloud computing company. So a lot of companies have put all their data with CrowdStrike, and then they had an issue with their Microsoft platform, and it caused, the biggest one that people saw was it caused United, American, and Delta to ground all their flights because they couldn't function. But a lot of companies are facing this right now, and we don't know what it was that caused it. Was it malicious? Was it incompetence? Don't know. Probably find out as things get back to normal. But yeah, that cybersecurity is going to be a bigger and bigger issue. So it looks like that's all the questions. So I hope everybody has a really great weekend, and we'll talk to you again soon. And again, if you have questions, please shoot them to me. I try to base a lot of this on the questions that people have. Take care, everybody.